The Wall Street Cat here. If you like money, this will be a pretty important presentation for you. It will be important to you for two primary reasons. The first reason why is related to my bio. So I will give you a little introduction of myself. Right after high school, my humanitarian profile triggered me to study international law at the Hague University. Then I continued my education at the University of Cambridge in the field of politics and international relations. Then I came back to Bulgaria, qualified as a lawyer, started working for the UN, and it is only then when I realized that I actually had an interest in the field of finance and investing. So it is important to decide early on what you want to do with your life. Secondly, if you go on to become a diplomat, a lawyer, a doctor, or whatnot, you could still invest your hard-earned income to generate a profit without taking too much of your time. And this video will do precisely that. It will give you a glimpse of a particular branch of investing called value investing, where you find cheap companies, buy shares in them, and then turn in a profit. Why is this important in this COVID-19 or even post-COVID era? Well, because in order to make money while investing, you only need a computer or even a phone and a brokerage account. So let's go on to value investing. The first question I want to ask you is, do you know who this man is? I mean, it's a cartoon version of him. Well, you guessed it right. So let's talk Warren Buffett for a moment. He is the third richest man in the whole wide world, and he is currently valued at around 76 billion US dollars. And he accumulated his wealth by value investing, by investing in undervalued companies. He reads about 500 pages of financial reports in his office every day, and he started a partnership in his 20s with only $100. And again today he is valued at about 76 billion US dollars. Most people think value investing is a get-rich-quick scheme. If you start investing today, you are not going to become a millionaire overnight. Moreover, it is not that complex actually. You do not need to be a rocket scientist. The only thing that you need to know is ratios, and ratios is something you learn in 4th grade. Okay, so this is what investing is not all about. You do not need to know Bollinger Bands, oscillators, moving averages, relative straight index, nothing of the sort. This is what traders do. They try to extract short-term profit based on the movement of the price of a stock. But this is not investing. You would want to invest for the long term, for decades to come. This is probably the most important slide. When you're trying to find a company in which to invest, the first and most important thing you want to check is whether the company is cheap. For this purpose, you need two ratios: price to sales and price to earnings. So what does a price to sales of 2 mean? It means that the price is twice as big as the sales of the company. Do you watch Netflix? At some point in the near past, Netflix had a PE or a price to earnings ratio of 400. The other criteria, well, that means that it is actually pretty expensive. The other criteria you need to check is, well, are the cash of the company that it disposes of, and its debt. The debt to equity and cash to debt ratios are particularly useful. You want the company to be a cash cow, or at least to have a cash cushion to sustain crises, like the coronavirus crisis, for example. And you need the company to have a low or bearable debt. For instance, right now the Fed is cutting interest rates, which means that even if a company withdraws debt from the bank, it could return the money on very favorable terms. And of course, finally, the company needs to grow its margins and profits. Let's now look into Facebook as an example. And by the way, this is a very useful resource called GuruFocus. So going quickly through Facebook's financial, you can safely say it is fine to invest in Facebook. A company is much like a person. It is a legal person actually. So what you want to look at in a nutshell is that this person has cash in the pocket, has a good salary, preferably does not owe money to anyone, and most importantly, he's not that flashy show-off. You know, he does not have an expensive car or possessions, but prefers to reinvest the cash. After going through the technicals, you need to also go through two more factors in your checklist: the product of the company and the management. I do not know whether you are aware who this guy is. He's called Peter Lynch, and he pioneered the concept of investing based on product demand. Of course, he would still care if the company is cheap, but he would focus on the product. For instance, he would go through his wife's drawer, see which cosmetic products she used, and then look up the company selling this cosmetic item, whether it is public or private and go through its financial statements. He would often go to the mall and basically put his money where there is demand and where there is no competition. So practically he would invest in monopolies. And finally, there is the management of the company. So you need strong management, honest, ethical management with manifest leadership skills. Let's talk another company, Match Group, the parent company of Tinder. After going to the technicals, you can see the company has a bit of a problem with debt, but it is still manageable since we live in a low interest environment, as we mentioned. But back when I invested, it was supported by its parent company called Interactive Corporation. So it even had less of a problem with its debt. Also, when I invested in the company was relatively cheap. But as you can see, these technical indicators and ratios change with time. Match Group is still turning a great profit, but what is best is that it is a virtual monopoly. Only Bumble is essentially competition. What you need to know is that I invested at around $30 only about 3 years ago, and my money has quadrupled. What does that mean? I made about 4 times my money. If you had invested $10, that means that you would have made 40. If you had invested, well, $10,000, you would have made $40,000. And had you invested $1 million, well, you would have made about $4 million today. One more thing, do not panic sell. There was this guy who was the mentor of Warren Buffett. He's called Ben Graham. He analogized the market with a bipolar person who has, his maniac ups and depressive downs. So when the market is down and even the stock is down, it is not always wise to sell. Here Match Group's stock price went down because of Facebook coming out with a dating product. But Facebook has its privacy issues, so no one would trust them with dating. The market assimilated this information and the stock continued to go up. The bottom line is that when you invest, you only need to look for change in the fundamentals. You do not even need to look at the chart every day, week or every month. You go on about your profession and only check your investments once in a while. It would, however, be counterproductive to look at charts all day long. And finally, if you thought this video was too boring and you do not like to look at financial statements all day, but still like the money, you can invest in an index fund, which tracks the economy of a particular country. The Vanguard Total Stock Market Index is an index that tracks all worldwide economies. But you can also invest in S&P 500, which is the pulse of the American economy, or an index tracking the economy of your home country, for that matter. This is what is called passive investing, and this guy, called Jack Bogle, is the guy who pioneered this endeavor in the States. This is it in a nutshell. But here we're just scratching the surface. To give you an example of what I do, I would just open a random quantitative analysis. Looks complex, right? Well, in order for you to understand the whole concept of investing, we started a website. It basically has value ideas, has growth ideas, and shows you basics on how to invest and trade. And also it shows you some stories of legendary investors and traders whom you might learn from. Finally, you can like our Facebook or Instagram pages where there is mainly fun content, but there is also some educational content. We also need to have fun after all while investing. That was it for me. Peace out.